And take it away, my friend.
Okay. Okay, I'm sharing my screen there. Can you see it?
Not yet. I see your beautiful face and that ugly Kansas City Chiefs thing in the background.
Oh man, really? You're n well, I feel for you. So,
I do too. All right, now we can see your screen.
but didn't you get some good draft guys? I thought you got some good drafts.
We always do, but you know how it is.
Yeah.
It's playoffs. That's a different story. So,
Well, it's like in golf, guys get within 7 feet and still choke. So,
yep,
okay,
yep.
we going through this then? We ready?
Yeah, yeah. So if you could, for those who don't know, just give a quick background on how you roll, what you got going on, and unless you're going to do that inside the sample, so I'll shut up and let you take over.
Okay, so just to give everybody a heads up, Business Planning Group is a national third-party administrator for a lot of different executive benefits is what I primarily do. We do some qualified plan stuff internally for ourselves, but we don't do it for agents. But we do third-party administration for executive benefits all over the country. And we've been doing it since 94. And our number one focus, always, when we're communicating with business owners, CPAs, and agents, is our goal is to try to find a tax deduction for the business owner. They are our primary client, not the HR people, not the CFO, nobody else. We do get a lot of referrals from CPAs directly. We get a lot of referrals from agents, and so the reason why CPAs refer us is because of the kind of deductions we can get for their clients on a personal level. And you'll see as we're going along, it can be pretty big depending on what somebody wants to do. So that's always our focus. So I always tell customers, I'm trying to help you uh, fund accounts with pre-tax dollars, not post-tax dollars. Post-tax is I'm a business owner, I take the money home, I pay my tax 30, 40%, whatever it is, and then I go buy products like mutual funds or CDs or a house or a boat or whatever I'm going to buy, real estate. Well, I've just paid a 30 or 40% premium for that product, and that's my tax cost. So we try to help them understand before you go buy those products that way, let's buy some products through the company that are pre-tax and save you that 30 or 40% that now you don't have to pay. Well, a lot of people don't know how group life really works. They've heard of it. They may even have it inside their company. And and so they may have $50,000 of term insurance, or their spouse does, or somebody. And in the United States, over 90 million employees have group term. It's the biggest financial product in the US. It's bigger than 401ks and almost as big as health insurance. Health insurance is about on that size, but it's one of the biggest employee benefits in the country. Every federal, state, city, county employee uses it. Every corporation of any size really uses it. It's one of the most common products on the marketplace. The only problem is, and I don't know why, I can't answer this question for you. It's impossible. Is the fact that the largest group life companies out there, like Minnesota Life and so forth, who have 10 million plus customers, don't know that they can use all of the parts of group life. And as I show you, you'll see what I'm talking about. They are unaware they can do it. I've met with them. They have no clue. And I can't get the two departments to walk across the hallway to introduce themselves. So, anyway, that's a long story. I won't complain about that any longer. So, we'll go ahead and jump on. Now, Phil, I've got Netra kind of frozen in the middle here. Does that mean anything?
No, I was to say I see your screen, so
Okay,
is is it
that's all that
impending on
matters.
what
Okay.
you're doing? Okay, good.
Yeah. All right. I'll get started. And if your screen is coming up where it's kind of wonky on the writing sample company, I apologize. Don't know how to change it right now. I'm not going to bother. We're just going to jump in. Okay. So this is what kind of a presentation looks like when I go to present this to a customer. And who I'm looking for as a customer is anybody that, number one, if they're already using a retirement plan like a 401k for their employees and themselves, they're a prime candidate for what I'm going to show you here. And here's why. When you're dealing with a business owner, they're maxed on what deferral they can use within the 401k. And this year it's 23,500. They can do some catch up if they're over 50. That's great. But they're capped at 33,000. Well, for a business owner who's making 500,000, 800,000 a year, they need more deductions. And so that's where we come in. Because when you compare a 401 Roth and group life, and you can see all the benefits that the group life has over a 401k, you'll see why the owner doesn't care anything about a 401k for themselves. When I make this presentation, I will present to them, okay, Mr. Business Owner, here's your 401k model. Here's your cap of how much you're going to put in. You're going to put in, get a current deduction. It's going to grow tax deferred. And then it's all going to come out 100% taxable. He goes, oh, okay, whatever. And then I go, now we have an alternative. You could use group life and you'll make the contribution from the company, take 100% tax write off. You'll have to pick up a portion of that, about 50 to maybe 70% of it at the most, and put it back on your income. But you get a 50, 40% deduction that you don't have to claim on federal, state, or payroll taxes. And then it grows tax deferred. And then when you take the money out during retirement, you have zero taxation. No federal, no state, no Social Security taxes. And if you want, you can even pass this on to the kids tax free. And that's how I explain this. That's how simple this really is. It's just people don't understand how group life really works. So let's go down. There's three parts to group life. The first part is up to $50,000 of term insurance. So me as the corporation, I'm going to buy all my employees $50,000 death benefit. It's going to cost me about $100 a year per person to buy that. It's the cheapest employee benefit they've got. And that's why so many people have it. We spend about $40 billion a year just on that product. That's how big it is. Okay. Then every employee in the company has a couple choices. Now, the company can say to all the employees, you know what? We love you so much. We're going to buy you one-time salary of death benefit. And so let's say Bob's making $100,000. Then they buy a $100,000 death benefit for him. There's no underwriting. The company pays for it. And Bob is supposed to pick up some of that and pay tax. I never see Bob pay tax on that. No one ever reports it. But me, of course, I report it if I've got guys doing it. And then the third part is anybody in the company, including the owner, because they are an employee of the corporation, they can now defer their own income into their own permanent life insurance account. And so they can say to us, hey, I want to put 5,000 in. I want to put 50,000 in. I want to put 500,000 in. I want to put 5 million in. There's no limit to how much they can put into their account per year. And we will fund these over a 5-year timeline. So if they say, I'm going to give you $200,000, it's $200,000 for 5 years. Now it goes into a permanent IUL. It will grow tax deferred, and then it will come out tax free. Now, when they go to make that contribution, they get 2 tax deductions while they're doing it. The first one is from the corporation. Why did they get that? Because this is an employee benefit. So the corporation writes the check, pays for the premium, and the employee picks up a portion of that on their W-2 and claims it. So at the end of the year, I'll come in and I'll calculate what that amount is for them. And I'll send that amount to you. I'll send it to the CPA, to the client, and then they put that back onto their W-2. So let's say I do 100,000 a year and I got to report 60,000 back onto my W-2. That's the reporting that takes place. That's it. There's no 5,500 filings. There's no insurance that's got to be paid for through defined benefit. That's how simple this reporting is. And HR people love that. And so does the CPA and owner of the company. At that point, now they have an account that was paid for by the corporation. It should be owned by the corporation, like the 401k is. It's not. It's owned by the individual themselves. So the company pays for it. The individual owns it outside the corporation. They control it. It's an asset in their personal name. Now, business owners love that asset protection that gives it. It's outside the assets of the corporation. So they just funneled whatever amount they wanted out of the company into these, and they've disappeared now forever through their assets. And they love that concept. Now, at that point, the business owner can do it. Their partner can do it. Their children can do it. Any executive in the company can do it. The ones that don't do it are usually the rank and file who don't have the kind of income that they could say, well, let's put 20,000 in there a year for me. Now, can the company bonus people to do this? Absolutely. And the reason why is, let's say they have 20 managers and they want to give 25 grand to all the managers. They can do that. And there's no discrimination that takes place. Because once you give everybody their $50,000 of term, then you've eliminated all the discrimination problems through this product. And now that company can zone in on anybody in that company they want to and give them a contribution with no discrimination. Why is that important? Because if they had to do the permanent contribution for everybody, well, what if they had 50 employees or 1,000 employees? They'd have to give it to everybody. But by doing group life, they can discriminate down to one employee. They can say to one employee, I'm going to give you $100,000 to stay at the company for 5 years with me because I love you and I want you to keep generating revenue for me. And those are the kind of employees that they'll give this to. So when you walk into a company, you may think, well, I'm just going to sell one package. You may not. You may sell two to the partners, to the three partners. There may be kids you're going to sell to. There may be managers inside the company that they're going to buy this for. So you never know how far you're going to dig into the company with this kind of contribution, but keep your mind open because it may kind of surprise you what you get away with. So, okay. I'm going to show you a sample now of everybody who's putting in $100,000 a year and walk you through how this looks when you go to pitch this to a customer. So I'm working off different age brackets so you can see a couple different things that I want to show you. I want to show you what kind of taxable percentage they have to claim. And then I want to show you how much income each account may create for them when they hit 70. And then I want to show you what their effective tax rate becomes because they use this product. And this is the one that CPAs love, is that effective tax rate. Remember that 30-40%. Okay. So let's just pick on the sample 50-year-old as the explanation, and you can see all the age brackets there. So they're going to put in $100,000 a year. So over 5 years, they'll put in 500 grand. Now they have to pick up 276,000 of that 500, and they'll do it year by year. They have to pick up 55% of that 500 grand. That's what they're going to claim as income. That other 45% just went up into thin air. By code, the IRS says we don't have to report that 45% ever to federal, state, or payroll taxes. And that's payroll taxes from the corporation and payroll taxes from the individual. It's a double deduction. And if you have enough people in the company doing it, that could be a big chunk of dollars for the corporation. So then we go down and we say, okay, Mr. 50-year-old, let's say you want to start taking income at 70. And I always run it the same timeline for every presentation, unless you guys tell me to do different. Is at that point, I'll say, okay, you're going to take 106,000 of tax-free income over a 20-year cycle. So you'll take 2.1 million out of this account. And then your initial death benefit was 1.7 million. So by putting that 100,000 in there, if you died the next day, you'd get that 1.7, or your family would. If you live to take income, then you're going to pull out 2.1 million of tax-free money from federal, state, and payroll, or not payroll, but Social Security. So then, how much tax did you pay on that 500 grand? Well, remember, you only had to claim 276. So if you're in the 40% bracket, you paid $110,000. Well, when you add up what you paid in tax, how much income you got out of this, how much death benefit, how much value you've got at 91 when we stop taking income, you pulled out a total value of $4 million for a $500,000 investment. Tax-free, with tax deductions up front. So your effective tax rate went from 40% to 2.7. But what if you're 35 and you do it? Your effective tax rate is 0.97. So CPAs love that. They go crazy for this. So anyway, so it's a great way to create an alternative retirement account through the corporation, taking the deductions that go way beyond the 401k. So whenever you meet a business owner who has a 401k, I just automatically say, well, that's great. Have you ever looked at the tax deductions of executive benefits and how you could use those too for yourself during retirement? And that may open a conversation. And that's good with CPAs too, because nowadays I find the majority, and I mean the majority, almost 100% of all younger CPAs have zero clue how this works. Some of the older folks do, but I find the younger folks, they have no idea what we're talking about. And the first time they see it, they're like, wow, that's fantastic. So anyway, any questions on this? Feel free to jump in and tell me what you think.
I was gonna say,
Because this is
thank
the meat and
God.
potatoes, huh?
I was gonna say, thank God you're young enough to share with all the other young CPAs as well. That's an amazing, that you caught on to this.
Well, I'm not that young, Bill. Thanks. Uh,
So, so a couple questions in the chat. So one of them is, what is the minimum size of employees that you can start this with?
Two,
How many? Two.
you got to have an owner and another employee. It can be their spouse. It can be two. So, and then there's no limit at that point. You can do 100,000 employees. The sweet spot for all of these is probably less than 100 employees. Once you get past 100 or 75 to 100, you start getting into CFO and HR people. And I hope none of you are HR or CFOs, but sometimes they're dumber than rocks. And trying to get past them with some concept like this, they can't do it. They literally just can't wrap their brain around it, which I think is
Yeah.
a shame. But hey,
Well, it's beneficial for us. I don't want everyone to know about this, right? So, Chris asked a good question. Is IUL always used, or can you use whole life?
no, always IUL, because whole life won't give us the tax deduction percentages we need.
And Chris, to kind of preface that too, because I think you might have jumped in late, but we have a exclusive strategic partnership on this type of strategy with Columbus. So Columbus brought this to the table. Columbus is the ones who actually, like, Ed vetted all of this out with Columbus's advanced sales team. and the structure there. So we are going to use Columbus with this design to help from that standpoint. I guess you would say get the pig through the python. So, in partnership too, everybody, you're not doing this alone. I'm not even smart enough for this. So, Ed would participate and he would just go on the app for 25%. But the opportunity to allow you these type of sales, in my opinion, is worth its weight in gold.
And I'm sorry, Phil, let me just make sure I help everybody understand. I only go on for 20%. They get 80, I get
Oh,
20.
oh,
Unless
excuse me.
sometimes you'll need me to, I've had national deals where I have to go to a compensation committee or the board of directors and things like that. So if there's travel involved and so forth to get things closed, then
Yeah.
I do ask for additional percentages to help cover things. But it's usually an 80-20 split. And when you're first presenting this kind of information, you'll want me on that presentation for at least 5 to 7 deals that you closed, because there's a lot of special language you'll have to use with CPAs. And if you don't say things correctly when they ask different questions and you make a mistake, they'll tell the client, these folks don't know what they're talking about, you shouldn't do this. And so it kind of kills the deal. I'm more than happy to stay with you while you're learning the conversation, and that may take 5 7 deals, which is okay. And then in the future, as you learn the paperwork, as you learn the conversations and the pitch, then you'll start closing these yourself. But I will still act as the third party administrator for you. So,
And another great question that popped up, and this I find a lot with entrepreneurs. So, what if an owner has multiple companies, like a controlled group, and with 401ks, you have to offer it if you have, dominant ownership. How does that work for something like this?
yeah, that's a good question. This always remember that group life is an ERISA program, just like 401k, and so there's discrimination rules we have to follow. And when you have a controlled group, then they have to include everybody into the group life portion, the 50,000 of term. And so as long as they meet that threshold, then we're fine. So
So I guess I'll ask the question that people probably want to know is that we get this started. So census, like what is the typical
system.
process? Mhm.
Okay, let me just finish up a few other things, and then we'll walk into that. Okay.
Perfect.
So when we first open a case, what I'll need from you guys is their census. And in their census, I just need to know all the employees, their ages, their wages. If you got job titles, great, those kind of things. And then what kind of company are we dealing with? An S corp, a C corp, LLC? How are they structured? Excuse me. Is it a partnership, family business? Um, uh, so, uh, and another side thing on that is sometimes when you have partners, you will sell multiple programs to every partner. So you may think, well, I'm just going to sell one for the business owner at 100 grand, and you wind up selling three for 100 grand. And so knowing who the partners are and so forth, that's great. We'll run those numbers too. And most companies have their employee information, just like a 401k census. Mine's identical. And they usually just send that over. They already have an Excel spreadsheet from QuickBooks or whatever, and they send that over. So once I have that, then I'm going to go in now. Oh, they're not pulling up. Okay, that part's not pulling up. I won't use it. For whatever reason, my presentation kind of went wonky. Let me get back to this. So when I get all that census information, I'm going to now come back and I'm going to customize the presentation to fit your client. So At the top of the presentation, I will put their name, their company name, right here. Where I've got sample, I'll put ABC Car Waxing Company, whatever, and then your name as the agent. And so it's all customized for you. And then we'll get into showing them exactly how the contribution and deductions are going to work for them, and then their employees, and so forth. So once you send me the census, now I can go to work giving you back the presentation that we'll now get in front of the client with. And then once you approve the presentation, then we're going to schedule the appointment with the business owner. And the way I usually like to do it is you want to meet with the business owner by themselves first, because a couple different reasons. One, a lot of times that business owner is fine with making the decision themselves, and then they'll include the CPA some other time down the road. Well, that's good. Great. I mean, we can move quickly, get everything wrapped up, get the insurance done. Everybody's happy. And then we educate the CPA. And if they're in your city, take them to lunch, show them everything. Maybe they'll give you some more clients. Two, some business owners don't want to tell their CPAs to be at this meeting because the CPA is going to charge them $300, and they hate that concept. So anyway, so I usually try to get the business owner first, and then the business owner is going to say two things. One, oh, this looks great. Let's go ahead and get it done. Or two, we need to show this to the CPA. Great. We'll set that meeting up. So either way, it works.
So, twofold question. First one was Tanisha, I'll kind of revise the question if that's okay. She said, can this only be offered to INC business structures? So I guess the better question is what business layouts are this good for? Like S corps, LCs, like what is the target market from a business standpoint
Yeah.
that we're targeting?
Yeah. So in the business world, when Congress set this up, it was back in the 50s. And in the 50s, the only corporation that existed at that point were C Corps. They had no idea what an S Corp was, an LLC, nothing. So every corporation in America was a C Corp. And this whole structure is based off C Corp. So what happens is nowadays, things have kind of flipped around. There's a lot of C Corps, but there's also a lot of your family businesses and small businesses are S Corps or LLC. Well, for all the employees inside the company, they can be processed through that S Corp or LLC, but the business owner, the main business owner and partners can't. They still have to be processed through a C Corp. And so what we do is we just set up a side management company that's a C Corp, and then we process their contribution through that corporation. Congress won't let us do it any other way. And so it's usually not a big deal because every business usually has two or three companies underneath its corporation anyway. And so having this management process for this is not a big fire.
I was going to say too, because you've done this before and you know how to do this, being the TPA for the plan itself, probably means that you're going to do it the right way. So that's a win right there. Um,
And the
so
CPA likes it because they're going to get another fee for filing the C Corp. So they
win.
don't complain.
Yeah. So the two questions here. One asked about like restaurant owners, and consider with restaurants high turnover, so that's always a question mark. And then nonprofits.
Okay, so nonprofits are just no go at all because there's no owners. But you can go in as an employee benefit package as group life. And so what that means is, let's say you got a nonprofit with 20 employees. Well, you can set up their group life just as normal group life, and then say, oh, by the way, you can make an additional contribution into these executive accounts. And so maybe the director of the nonprofit, they'll give him 25,000 to do it, or give her 100 grand to do it, or you never know. And then you would just process it like you would any other corporation. And they're just employees. They don't own anything because nonprofits aren't corporations like normal. So,
Okay.
and then restaurants, there are, when you're doing group life, there are some really main customers that we always try to focus on. The number one customer for this kind of executive benefit is a blue collar corporation. You would be surprised how many construction companies do this for the owners.
Hmm.
It's a big deal, and white collar doctors and people like that, they think would always do this. They don't. They're too smart for everything. And so I don't argue with them. It's mostly all of our accounts are blue collar corporations. And that's auto body shops, that's construction. When it comes to restaurants, it's a really unique product simply because let's say I go to a McDonald's franchise owner and they've got 2,000 employees and they go, holy moly, if I've got to pay for all those employees to do group life, it may bankrupt me, which is not true. But within the guidelines of group life, I can now carve people out. Just like in retirement plans, I can carve people out. Well, group life has the same structures that I can use. So when I get done, that company may have 2,000 employees, but only 25 employees that I have to pay the group life for, the 50,000 a term. And now the owner can contribute as much as they want. So restaurants are great customers.
To kind of piggyback off of that, let's say, for example's sake, it's a IT company or something like that, and they already have through ADP or whatever group life. So can we not be the sponsor of the group life and just attack the, let's be honest, where the money's at? Or
Yep.
do we have to do both?
Nope. And if you find a company that's already got group life attached, I don't say a word. I applaud them. I go, oh, that's great. You got Hartford. Love it. Keep it where it's at. I don't argue with them because I don't want to bring that agent into the conversation because they may poo poo your deal just to do it to you because they think you're trying to take their little group life account. Group life really doesn't pay any money. I mean,
Nickels.
think about it. The average premium is $100 a year. You're making $8, $9 a year off that employee. It doesn't pay to do it. But that agent may still knock you out because they didn't want you to take that. So I don't say anything if I don't have to change that out. I just go, that is great. You got it set up. We're just going to layer this on top of it. And now you can use the executive benefit portion.
So I got a kind of a strategic question, right? We've had a small business summit earlier this year in Miami where we had people from Lafayette come out. They have their own little department for 412s, cash balance plans. So um, obviously you're a CPA as well. So from your standpoint, where do you see one better than the other? Do they work, in sync, or are they more like competitors of each other?
Okay, so let me just back up a sec. I'm not a CPA for this stuff, Phil.
Okay,
I
my
won't be
apologies.
filing the taxes. And so I'm a third party administrator for this kind of stuff.
Okay.
And when it comes to defined benefits, how do I say this politely? If I was competing with a defined benefit right now and group life, I would beat that defined benefit.
It
I
wouldn't be
do it
much
all
of a
the time.
competition.
Well, I do it all the time to myself through my own accounts because when you have a defined benefit, let's say the owner can take $250,000 contribution, right? Part of
Yep.
it could be in life insurance, and part of it may be in mutual funds or whatever. But now, because of the structure of a defined benefit, he has to include so many employees and he has to contribute so much to those employees. that when I get done showing him how much he's going to contribute off group life, he won't do the defined benefit.
Right.
It just won't happen.
Well, I was going to say because of the limitations and everything. Now, do you find that because obviously with defined benefit plans, you have limitation in product scope really too. So, do you find that someone might do a 401k, maybe a cash balance or profit sharing plan, and then do this on top of that so they get some like variable
Yes.
opportunity and then couple this in?
Yeah. So a lot of our internal clients, we have 401 profit sharing set up and they use that every year. And then they take those dollars they would have dumped into cash balance or something else and put it in this
Okay.
because of the back end tax free income cycle.
So to kind of cycle back to Chris, your question, if you have someone who's more friendly towards like a whole life, maybe the cash balance plan makes more sense. Whereas this, you have a little bit more flexibility and frankly, some higher tax deductions when you look at that from this standpoint. So, um,
Yeah. And just
uh,
remember when you move out of those qualified plans, every penny is taxable. So when the customer hits 70, 72, they're going to have mandatory withdrawals and every penny's taxable. Where now, if they use this over the years as part of their product mix, they won't have taxes on this product. So you're customizing the plans and giving the consumer options that I think are very helpful.
um, so Rajesh had a question about a Venn diagram of company structures that would be target market. You already kind of answered that. More of your blue collars, not your posh, doctors and dentists because they already know what they're doing. But a good one for several agents on this call. We deal with a lot of, let's say, hoteliers, gas station owners, things like that. Uh, again, that multiple property thing, but or businesses, controlled groups. So have you seen people in that realm kind of take advantage of this?
Um, yeah, I mean, no matter what kind of businesses they own, they can have so many different corporations. It doesn't matter, but you do have to follow the control group rule to write up the term insurance for everybody.
Gotcha.
So he
Yeah.
can't say, well, I'm going to do the term insurance in this company with 10 employees, but in that other company that I got 500 employees, I'm not going to do it with. You can't do that. You have to have everybody included in the term insurance. And
Mhm.
uh, so for some companies, depending on the size of the corporations, uh, uh, if I can carve them out properly, they'll still do it because it's so affordable.
Yeah.
That $100 a year is just nothing as an employee benefit.
I'd be remiss to not ask this. Can you do premium finance with this too, or no?
No, because
Good.
premium finance has nothing to do with salary deferral, right?
Perfect. Just
All right.
just making sure.
We've tried. We've talked to our attorneys how we're going to do this, and we if we could get away with it, we would do it. But it
I don't want to
is
make it any
good.
more complex.
Well, yeah. But it all comes down to your. This is all really based on salary deferral concept, and
Mhm.
so it's tough to do. But you can do legacy planning with it.
Which is
You bet.
great. Yeah.
And they're
Which
doing
actually
it
reminds
with an
me,
upfront, huh?
which actually that leads to a good question. So let's say you have a business owner who is 65, 70-ish, and they can still participate in this even though their retirement years they're already in them, even though they don't plan on retiring kind of thing. It's still, there's no age limit on this.
Yeah. So, well, there will be when they get to a certain age, the deduction is so small. Should they
Okay.
do it, not do it? So they will get to an age where it just doesn't make a lot of sense, depending on their planning. If they're doing legacy planning, then I would always do this first because I'm going to take a good deduction anyway. Where
Mhm.
if I just took the money and paid the tax and then gave it to a charity or something, well, I still paid that premium to make that donation. Where I can do this, get a tax deduction, still make the donation, and save even more money. So that's what a lot of folks think about at that point. And this product is very unique if you ever do business succession planning with a family.
Go on.
And it will shock you how much premium you get away with. So let's say I got a family and I got three kids in the company and they want to buy the company. We're going to pre-fund part of mom and dad's buyout. And we're going to use this structure to do it because there's a tax deduction. But guess what? The kids never pay the premium. The corporation does.
Hmm.
And then they get to discount that off the value. And mom and dad took it as a tax deduction, well, double tax deduction. And now that account is 100% tax free outside the corporate tax cost. So if mom and dad were going to be paying 21.35%, they eliminated that by using this product. And then the kids never had to pay the premium. So they eliminated that cost. And there's so many ways it saves money for a family owned business. It's one of our go-to products if we can get that scenario set up. And your premiums will usually be between about we usually see about 300,000 to 600,000 a year.
So let me think of this because obviously I'm an opportunist as well. So I need to get, I know,
You mean
right?
you're a business person? So
Potato, potato. So let's say I need to get coverage for myself, right? And I'm thinking to myself, well, hey, I need $5 million of term insurance. Okay. But on the flip side is in my thought process is that if I didn't do that, and my wife and I are 50-50 owners of Valor, from that standpoint, I could essentially buy a $5 million permanent policy and pay the premium for that and get a deduction off of that. Now, does it have to stop after 5 years or can it continue in perpetuity, however long I run everything?
yeah, no, we set them up in 5 year increments of payments, and we
Okay.
don't want to go past the MEC limit. That's kind of
Yep.
some of the focus of it. And what I always tell my customer is we're not buying this for the death benefit as much as we're
Yes.
buying it for the deduction because
Yep.
we're going to come back into this product about 8 to 11 years and we're going to start dropping the death benefit. And the reason why we're going to do
Ah,
that is save on insurance costs and
fees.
pump up income.
Okay. Okay. So that's a great, I like that. So limit to 5 years. You have the opportunity to, and that's why we have the $100,000 here as the sample study. So you don't want people who are going to do, well, I can do 10,000 a year because that's not really a deduction conversation, right? This
Right.
is more for six-figure or higher end, so to speak.
Yeah. And what we
Okay.
find is younger people that do it, and you'll see some 25 or 30 year olds doing it, especially if they took the company over from mom and dad or somebody, or they've done really well in business. They'll open an account for 5 years. And here's some big things about group life that are different than a 401k. If
Mhm.
I'm doing a 401k, I can only contribute to one 401k. I can't contribute to five 401ks. In group life, I can have five of these accounts set up at the same time. So I can start one today, and you'll see this for yourself when you go back to do your annual reviews with some companies. They'll go, "Oh man, I just want another contract. It's for 5, 10 years." Oh, great. Then let's do another account. And so you can do multiple accounts. And then when that 35-year-old does one account for 5 years, maybe they want to do another one at 40, 45, 50. So when they get into retirement, they may have three, four, five accounts open and ready to take income from. And so I kind of look at it like it's a long-term play with younger people as if it was a 401k permanent account.
And not to say that we're in this for the money, of course, but you have to do one every 5 years.
You have to do
And
it.
twist my arm. And a cheap, shameless plug for those who haven't really dabbled in the Columbus product. Once again, you do good for the customer. They keep that IUL going. On the cash value, you get trails of growth from the cash too. So they reward you for taking care of your clients. No other company does that. So just another reason why the exclusivity or opportunity here makes a lot of sense. So,
And
and
they're the only insurance company in the US right now that has completely vetted this process with their attorneys and compliance department and
mhm.
support this whole process. And we used to have quite a few companies that did it, but they've changed their business models over the years and kind of dropped off using qualified plan structures, executive benefit structures, and kind of given up on the marketplace. Uh, and so we can't use them anymore. So Columbus is one of the only ones that have done this. So yeah, I think it's a big deal myself.
It's huge. It's absolutely huge. All right, I know we're coming close to time, so Maia has a question. The income at retirement, is that through loans in the IUL? It's a great
Correct.
question.
Yeah, always. Yeah.
So once again, that tax favored benefit, you use the loan structure and, they also have the overloan protection rider too. So if you get close to that total cash value, instead of lapsing your contract, you can turn on the overloan protection rider. Um, Prajesh had another question. Do you have a flow chart? I know you have the one, two, three, but do you have like a flow chart from start to finish, so clients can discuss with their or agents can discuss with their clients, I guess is the best way to put it. Like do's and don'ts or is what you see is what you get.
No, the best thing to do is when you because you can see this is a little complicated. It's not something that I wouldn't give a lot of this information to a customer. Uh, their eyes would spin through their head. Is I would just ask them, are you looking for more tax deductions from the company for your personal use, and then schedule the meeting. I'm more than happy to get on that meeting with you, walk through. And all the agents say the same thing. Hey, Ed's the third party administrator for this process. I'll have him explain how the structure works. And you just sit and watch and listen and learn how it works. And that's the best way to do it. And then if the customer needs information from that point, then I'm more than happy to provide any kind of presentation materials they need. I've got booklets, I've got all kinds of stuff.
The other thing too, from that standpoint is, as we've talked about in other meetings, it's not always, you don't have to know this. You have to know the people who know this. So if I came up to you today as a business owner and said, "Hey, did you get enough tax deductions last year?" If you want to sit down for 15 to 30 minutes, I can talk about different ways where we can provide tax deduction strategies. And if it makes sense, we can set up an educational conversation. So it doesn't mean you have to know everything today, but the idea is that you have resources that are available at your fingertips to help you increase that echelon and grow that business. And that's the most important part here and why we're talking about this today. So, does anyone have like one last question or so? I know we're getting kind of close to time. Any anything? Michelle, are you waving your hand? Yeah.
Yes, please.
Yeah.
So maybe I missed it and I apologize. If we had somebody that we wanted him to talk to, how do we get a hold of?
I will put that in the newsletter.
Okay.
So I'll have all of Ed's information there.
Okay.
Unless Ed, you want continuity. If you want to come through me, we can do that too. It's up to you. I don't want you
What,
like
however
overwhelmed.
your structure set up, Phil, you just do what you got, what you want as far as introductions and so forth, and
Yeah.
however your system works. I don't know.
Yeah, it's an open and independent system. So what I would say is that if anybody, I'll put the information in the newsletter. So one, that means that you actually have to read it, suckers. And two, from that standpoint, if you just say, Ed, got your information from Phil, so there might be that correlation there, but you're all independent. Just kind of remember what he said here. From a structure standpoint, it's a 5 pay. It is for people who are looking for these type of deductions. So we're not looking for a $5,000 annual premium because that's not going to give you the deduction you're looking for. Okay. So just thinking context, if you want to talk to me about it first to see if the gross is worth the grief, and then we bring Ed in, I'm perfectly fine with that as well. That's obviously what you have me for too. So,
Yeah, and I would filter through my clients I've got. If you have business owners in your process,
mhm,
then I would definitely think about what are you selling them today as a product, and then can you add this into it? And then a lot of times agents will just say to that business owner, "Hey, I think I've got something that could really help you save on taxes for your personal retirement. Can we? And I can throw some stuff together. Can we get together and have a conversation?" And then at that point, you could feel free to bring me in on a conference call and so forth. So that's what most people do.
perfect. All right, folks. Well, we've hit that time. And so what I would say is if you have any questions, feel free to give me a call. Um, no, I don't think this is a 1035 thing, Nana, so it's new monies. Um, but yeah,
Yeah, the
appreciate the opportunity.
1035 will throw up the taxable percentage, give them less taxable percentage. It will throw it off. It can work, but it does throw it off. So you have to just be ready for that.
Mhm. So all right, guys, this will be up on the YouTube. If you have any questions, give me a holler. Once again, Ed, thank you so much. And guys, you have a great rest of your day. If we don't talk, great weekend. And we'll be back at it next week. Tuesday, health trainings. Wednesday night, back to basics. Thursdays, same time, same channel. Have a great day, guys. Thanks again, Ed.
Thank
Thank you,
you.
Okay,
Ed.
thank you.
What an
Have a good
amazing
day. Bye
eye-opening.
bye.
See you guys.